Saudi Arabia just made a move that could change how the entire world pays for oil. If you hold dollars, own US stocks, or have a retirement account, what happens next touches you directly. Here is the central paradox you need to keep in mind for the rest of this story. Saudi Arabia did not just participate in the dollar-dominated oil order, it was the load-bearing wall for that entire system. Now, the kingdom is sitting at a table with China, Russia, and Iran to explore what the world looks like if that wall is removed. The real question is whether this is a genuine shift in strategy or just a pressure tactic meant to look like a revolution. The answer to that question changes everything for oil markets, US debt, and every dollar-denominated asset sitting in your portfolio right now. Act 1. How the petrodollar was built and why Saudi Arabia agreed to it. To understand why the events of 2023 matter, you have to look back at 1974. The US had recently abandoned the gold standard, which meant the dollar was floating freely, and the world needed a concrete reason to keep holding it. Nixon and Kissinger flew to Riyadh and came back with an arrangement that solved that problem for the next 50 years. The deal was straightforward. Saudi Arabia agreed to price its oil only in US dollars and promised to invest its extra oil cash back into US Treasury bonds. In exchange, the US provided high-tech military hardware, security guarantees, and a permanent naval presence in the Gulf. Washington also agreed to protect the political legitimacy of the House of Saud within a Western-led order that might have otherwise treated the kingdom as an outsider. Think about what the US actually bought with that arrangement. It did not just find a trading partner, it manufactured a global demand for dollars that no other country could ever hope to match. Because every nation on Earth needed oil, every nation on Earth suddenly had to acquire dollars first. Every oil exporter with extra revenue had to park that money somewhere, and US Treasuries were the only market deep enough to handle it. Economists call this an exorbitant privilege because it allows the US to run massive trade deficits and borrow money at lower interest rates than anyone else. This system acted as a permanent subsidy for American borrowing, and it was paid for by every other country, every time they filled up a tanker. Saudi Arabia's side of the deal was just as logical. Between 1974 and 2020, the kingdom bought over $100 billion in US weapons and lived under a security umbrella that protected them when Saddam Hussein's army was on their border. They gained guaranteed access to the world's largest economy and a seat at the table of the US-led order. The system held for 5 decades because both sides genuinely needed it to work. Riyadh was never a passive victim in this story. They were an architect of the system. But the conditions that made this architecture worth keeping have been fading for over 10 years, and the events of 2022 turned that slow fade into a collapse that can no longer be ignored. Act 2. The cracks. What actually pushed Saudi Arabia toward BRICS, the single most clarifying event in this entire story, did not happen in Riyadh. It happened in Washington in February of 2022 when the US and its allies froze about $300 billion in Russian central bank reserves held in Western banks. This happened overnight. There was no court order, no public process, and no formal mechanism that other countries could look at or challenge.
Well, the US Treasury Department has announced that it will freeze all assets of the Russian central bank held in America.
Every sovereign wealth fund on Earth watched that happen. The Saudi Public Investment Fund, which sits on over $700 billion in assets, watched it very closely. The message was that dollar reserves are not neutral stores of value, but are instead hostages to American foreign policy. That realization landed in Riyadh on top of a stack of grievances that had been building up for years. The war in Yemen put Saudi Arabia on the wrong side of opinion in Congress and led to repeated US threats to stop selling them weapons. Then the 2018 murder of journalist Jamal Khashoggi inside the Saudi consulate in Istanbul created a rift that Joe Biden made worse when he released a CIA report naming Crown Prince Mohammed bin Salman as the person responsible.
Now, this all comes as President Biden looks to reevaluate America's relationship with the kingdom.
When they finally met in 2022, that famous fist bump on the tarmac did not fix the relationship, and it only made the tension visible to the rest of the world.
Saudi Arabia, the president greeting the Saudi crown prince right there with that fist bump.
U.S. officials say MBS ordered the murder of journalist Jamal Khashoggi, an allegation the crown prince has denied.
Underneath all of this, the U.S. shale revolution had changed the math of the entire partnership. America went from being the world's largest oil importer to a net exporter, which meant the urgent need to protect Gulf oil supplies had softened in Washington. Even though Riyadh still needed the American security umbrella, the strategic reason for that umbrella was starting to fade. The first public sign that the deal was under real stress came through OPEC+. In October of 2022, Riyadh and Moscow coordinated a 2 million barrel per day production cut. And they did this despite direct requests from the Biden administration to keep output steady before the midterm elections. This was not a technical decision about the oil market. It was a statement. Then came the yuan. In early 2023, Saudi Aramco finished its first oil trade settled in Chinese yuan through the Shanghai Petroleum and Natural Gas Exchange. The actual amount of money was small, but the geopolitical strategist Parag Khanna noted that these trades were not just a currency swap. They were a proof of concept. They showed that the technical system for settling oil trades without the dollar exists. It works, and it has the full support of the largest oil importer in the world. You can call that a negotiating tactic if you want, but that label misses the bigger picture. Negotiating tactics do not require you to build entirely new financial plumbing from scratch. When you build the pipes, you intend to use them. Act 3. What the trajectory actually looks like and what it means for your money. So where does this actually go from here? I'm not talking about the headline version, but the structural version of the story. The petrodollar does not collapse the way a building falls down. It shifts the way a river changes its course, where one season the bank wears away a little, the next season a little more, and then one day you look at the map and the water is somewhere else entirely. There are 3 mechanisms running right now that show you exactly which way the current is moving. First, those yuan-settled oil trades are not going to stay small for long. China buys about 25% of all Saudi crude exports, and the currency swap lines between Beijing and Riyadh give both sides the tools to go around the dollar whenever it is convenient. Second, the BRICS nations are building payment bridges between their own central banks. The M-Bridge pilot is a project connecting central banks in China, the UAE, Thailand, and Hong Kong, and it already handled real transactions back in 2022. It is not a theory anymore. Third, Saudi Arabia joining BRICS means it now sits inside a group that represents over 40% of global GDP.
Ramaphosa said that Riyadh wants to join BRICS.
This group has a clear goal of moving away from the dollar for trade. Now, none of that means the dollar is finished today. The former IMF chief economist Kenneth Rogoff has pointed out that being the reserve currency comes with a lot of momentum that is hard to stop. The legal contracts, the bond markets, and the deep pools of money in the US cannot be replaced in a single night. As Rogoff put it, dollar dominance and dollar decline can both happen at the same time. The dollar can stay the largest reserve currency in the world, while its total share of global reserves continues to drop. We have already seen this happen, as the dollar fell from 73% of global reserves in 2001 to the 58% it holds today. That is the part that matters for anyone watching this as an investor. The actual play for Saudi Arabia is not a total exit from the dollar, but a dual positioning strategy. Riyadh is keeping its old dollar relationships while they build the option to settle trades in other currencies when it helps them. They are not burning the old bridge, but they are definitely building a second one. That second bridge is their leverage, because the US can no longer expect unconditional loyalty to the dollar, and that changes every negotiation. The history of the British pound after the Bretton Woods Agreement makes this very clear. Britain did not wake up one morning and find its currency was suddenly powerless. It took 30 years of slow displacement from 1944 through the middle of the 1970s. The people who saw that transition early and moved into dollar assets or commodities did not need to know the exact date it would end to make money. They just had to see the direction. Macro strategist Zoltan Pozsar, who used to work at the New York Fed, argues that we are seeing the start of a new monetary order. He believes this system will be anchored by the countries that produce commodities rather than the country that prints the money. Whether he is right 20 years from now is still uncertain, but the fact that Saudi Arabia is hedging its bets is the only data point you really need. When the country that helped build the current system starts building an alternative, it tells you everything you need to know about the confidence of the people on the inside. You shouldn't look at this as Saudi Arabia dumping the United States, but rather as a kingdom, refusing to be anyone's captive. The petrodollar era is not going to vanish this year or even next, but the monopoly on how the world pays for oil is already cracking at the edges. These cracks are appearing because the very people who built the system decided that the risk of staying fully inside it was finally too high. That is the signal. If you want more investigations into the hidden financial systems running underneath the headlines, subscribe and share this video with someone who needs to see the truth.